Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. So since the collapse of the Silicon Valley Bank a couple of weeks ago, we've had a brief market panic, but more importantly, lots of signs of contagion in the banking industry around the world. We've got Credit Suisse that completely collapsed. More recently, the regional banking ETF still down massively ever since the bank run on SVB. So all of this is sparking a lot of fears that we're currently in the beginning of a second banking crisis similar to what we had in 2008. That we're about to enter that final phase, that waterfall sell-off that we had in October of 2008 as the financial system was in complete free fall following the massive credit bubble that we had leading up to 2007. Now, if we actually look at United States household debt to GDP, we don't see that we're in quite a similar situation to what we had in 2008. Household debt to GDP is down significantly from its levels in 2008, where you did have a credit bubble that led to the financial crisis and was followed by deleveraging of households following the financial crisis. So we're not in the same situation that we were in back in 2008, and the market knows this. So in this video, I'm going to show you the real reason why stocks are going to decline here. It's not because of a banking crisis. It's not because of a credit bubble popping. There's another very important dynamic that's currently playing out right now underneath the surface that is going to drive the stock market lower this year and the economy into a recession. So pay attention very carefully and make sure to smash that like button if you enjoyed this video. And of course, if you are new here, subscribe to the channel. Now, without further ado, let's get right into it. Now, Silicon Valley Bank made a massive number of loans in the 2020 to 2021 period. Now, this is a big part of the dynamic that drove Silicon Valley Bank into bankruptcy, and this is exactly what could cause a lot of stress in the system over the next few months. Now, remember, these couple of years here, this was back when the Fed was telling us that it was going to keep rates very low for a very long time. So it wasn't such a bad idea to make a bunch of loans at low rates here because we were in a low interest rate environment, and that's what the Fed was saying. And the Fed was telling us that was going to be the case for quite some time. So look at this asset growth that we had throughout this period. SIVB made a massive number of loans at very low yield in an environment where you had low yield. Now, of course, since then, we've had yields skyrocket. So a very different environment to the one that they had in 2020 and 2021. So if they were loaning out money at very low interest rates, then of course the deposit rate had to be low for the bank to be profitable. SIVB was basically a bank that was loaning out money at a very low rate. And if you deposited that money in SIVB, you also had a very low deposit rate. Now, remember what happened to the federal funds rate here in 2022. We saw it go from 0% to 4.5% in the fastest tightening cycle in history. Now, even in the 70s, where you did have very aggressive tightening cycles from the Federal Reserve, you didn't have problems like this because you never went from a 0% interest rate environment where the Fed is telling you that you're going to stay at 0% interest rate for the foreseeable future all the way to 5%. That has never happened since the Federal Reserve was created in 1913. So of course, when people realized that the deposit rate at 0.5% was 8 times lower than what you get in a money market fund, of course people withdrew their deposits. And this was not just at Silicon Valley Bank. This is across the banking industry. Investors have been taking out their money from banks, not necessarily because of the financial instability of the system, but because the deposit rate of these banks is just unbelievably unattractive at current levels compared to the rates that you get elsewhere in the market. So until you actually see the deposit rate somewhat catch up to the current rates that we have in money market funds, you have the system that is vulnerable to more deposit withdrawals and just a general weakening of the banking sector. The only way that stops is if the banking sector actively shows that it is raising its deposit rate. This is what is going to take us into a recession. Because ever since SVB, the market knows that this is the direction that we're heading in. This is why oil has been selling off very aggressively since the collapse of SVB. The same thing goes for copper. Very aggressive sell-off since the collapse of SVB. Oil and copper are economically sensitive commodities that reflect what economic growth, what global economic growth is going to look like in the future, and they have been selling off, telling us that global growth is going to decline following the collapse of SVB. Now, why is that the case? Why does a higher deposit rate mean lower economic growth? Because, of course, the banks are going to tighten their standards, meaning that they're going to need to raise the interest rate at which they lend money. You can see throughout history, going back to 1989, this is something that we've discussed before on this channel. When banks tighten their lending standards, it triggers a recession. Banks tightening their lending standards, triggering a recession. Now, before the SVB collapse, we already talked about this, lending standards were tightening right here with already the worst lending conditions since 2008, the global financial crisis, if you exclude the COVID phenomenon, which of course was completely unnatural and had nothing to do with the actual business and monetary policy cycle. So let's exclude COVID, but 2008, 2001 and 1989 were all recessions that were triggered as a result of a tightening of lending standards. So banks are going to need to do the exact opposite thing that SVB did right here. SVB in this monetary environment made a huge number of loans at very low yield. If banks want to be taken seriously, if they want to stop this exodus, this massive withdrawal phenomenon of bank deposits, they're going to have to do the exact opposite, which is make very little loans at very high interest rates so that they're going to be able to raise their deposit rate and become competitive relative to money market funds. And so, of course, you're going to see lending standards tighten dramatically as a result of this phenomenon, which essentially is going to pull forward the recession and deepen the recession that is coming in the next year. Visually, I can add the unemployment rate on this chart so you can understand what the timing of all of this is. And you can see here, lending standards are very tight. Right here in 1989, what happens to the unemployment rate? Well, it begins to rise in the months after. Even though lending standards loosen afterwards, unemployment rate rises. Remember, unemployment is a coincident economic indicator. You can see here, same thing in 1999. Lending standards are tightening very significantly right here. And then what happens to the unemployment rate? It begins to rise. And this is as the market is falling, of course. The market topped in October of 2000 and really bottomed in around 2002. And of course, same thing right here. Lending standards tightening very significantly towards the end of 2007. Market topped in around October of 2007. And that was followed by a deep, deep recession and a rising unemployment rate. So we can expect the same thing this time around. This time is not going to be different. Now, we don't necessarily need a banking crisis, a financial crisis to the extent that we had in 2008 in order for us to enter a recession. Now, some people argue that a recession has already been priced in and that stocks are heading higher from here. Of course, we don't believe that's the case. Analyst estimates are clearly expecting growth in S&P 500 earnings throughout the next 12 months. They've been betting on the fact that the consumer is resilient, that China is on an economic boom again. We don't think those arguments are actually going to hold up. There's a lot of repricing to do in terms of S&P 500 earnings, in terms of the economic growth outlook. We're heading for a hard landing, not a no landing like analysts are currently pricing in. Now, this week, the Federal Reserve is going to speak, and there is a non-negligible chance that they actually try and calm down the situation very significantly, start to talk about possibly pause monetary policy, and even start to talk about some rate cuts in the near future. Depending on how aggressive they are with their shift in the tone, it may trigger some optimism in the market before the recession actually begins to get priced in by the market. So watch out for that. You might get that Fed pivot rally for a few weeks before you actually get the real recession trade. If you want to find out how we're positioning for these developments, we do have a model portfolio at gameoftrades.net that is exactly adapted to what we believe the environment is going to look like in 2023. The service is designed for the individual investor who who doesn't have the time to day trade, but wants to be invested in the right assets at the right time to consistently beat the S&P 500. We make all our updates extremely direct, straight to the point, so that you get all the actionable information as quickly as possible. And that's all for a ridiculously cheap price. So get yourself a free trial if you are interested in this type of service. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to leave us a like and subscribe to the channel if you have not already. Now, in the meantime, I wish you good luck on your trading and see you next time.